Hi everybody, welcome back to the channel. And today I thought we'd talk about 3 Vanguard ETFs that I'm a personal favorite of. These are some of my favorite Vanguard Dividend ETFs. And when it comes to dividend investing, you want to keep in mind the fees of the ETFs you're investing in. Also with these ETFs, keep in mind the name Exchange Traded Fund, which is what an ETF is. What that essentially means is you can buy these just like you would a regular stock. So that's the beauty of it, is you can go ahead and buy these through your stockbroker. And if you don't have a stock brokerage account, you can go to Fidelity, Schwab, any of those brokers will do the trick. With that being said, the first ETF we're talking about is the Vanguard Real Estate ETF. Now, one thing I love about Vanguard ETFs is they have relatively low expense ratios compared to others. This one has a 0.13 expense ratio. And as the name implies, this one invests primarily in real estate investment trust and real estate companies, so REITs, and companies that purchase office buildings, hotels, and other real property. So keeping in mind that office buildings are maybe not the best investment, hopefully this ETF will kind of shift away from that over the long term. You'll see that one thing with this ETF is that the share price has really not done a whole lot since 2020. We've come up about $20 a share, currently trading at roughly $83. And if you look at the shorter term chart here for VNQ, you can see that we came up from about 72 in November. That was the low, and now we've just kind of been in this sideways trading pattern ever since, what was this? I guess really the beginning of 24, honestly, is we've kind of been in this downward wedge pattern almost. And so when it comes to something like this, just keep in mind that you're investing for the cash flow, the dividends, and any kind of share price appreciation will be a bonus. And it's not fun to see, especially when the market's hitting all-time highs and we have Nvidia and all these growth stocks going crazy. But that is one of the trade-offs and also one of the main benefits of an ETF like this, because quite simply, when the market declines and people are becoming fearful again when it comes to growth and all that kind of stuff, an ETF like this will hold up a lot better in that type of market. It just will. In general, you're going to have lower volatility with an ETF like this because you're well diversified. And so that's one of the main benefits and drawbacks of investing for cash flow, especially in a diversified ETF like this. You'll see that we have a lot of the different metrics on the website. You can kind of take a look at that if you want. We also have the portfolio composition, 159 companies, earnings growth rate, PE ratio, and all that kind of stuff factored in to the ETF. It has exactly what type of REITs it's investing in, the percentage of REITs. So we have data center REITs, multifamily residential REITs, office REITs, all of that type of stuff. And then we also have the actual holdings themselves. So one of the companies I've discussed on the channel, for example, is Realty Income. This is one of my favorites, even though real estate has been kind of heavily hit from all of this stuff happening after COVID. There's been a lot of REITs in particular heavily hit. So it'll be interesting to see what happens here long term. But nonetheless, you kind of see some of these names like Public Storage. I think storage center REITs are pretty good. Some of these companies, though, you have to keep in mind that real estate is changing. Office buildings are not as, in use as they used to be. There's a lot of vacant office space. And so real estate is always going through these different shifts. A lot of rental markets for single-family homes are still very hot. But obviously real estate prices themselves for single-family homes are elevated right now. So it really just comes down to what type of real estate you're investing in. This is a broadly diversified portfolio, so it's going to invest, as the description implies, into a wide variety of REITs. With that being said, you can see here that it yields currently 4.93%, annual dividend over $4 per share, and it pays on a quarterly basis. You can see here the most recent distributions. And with that being said, you're looking at sometimes over $1 per share every single quarter, so that comes up to roughly $4 per share. And this is the Vanguard Real Estate ETF, or VNQ. With that being said, let's move on to the next one. That's going to be VIG, or the Vanguard Dividend Appreciation Index Fund. This one right here is definitely going to be geared towards those of you who care more about share price growth, and also when it comes to long-term dividend growth. So when we're talking about dividend growth, what I mean is, let's say these dividends right here, for example, versus what dividends were they paying 10 years ago. You know what I mean? So we have a dividend of 40 cents per share, and now they're paying, let's say, 70 to 80 or 90 cents per share. So that's pretty much double what they were paying 10 years ago. And I've talked about this ETF on the channel as well. And the dividend yield itself is lower, so less than 2%, which is actually lower than the Fed funds rate. I think even for VNQ, the Fed funds rate is like 5%. So even though the dividend yield is lower on this one, but just keep in mind the dividend growth itself, like when it comes to keeping up with inflation and stuff, that can be a major thing to consider. And if we look at the actual website itself on Vanguard, you can see the current market price and net asset value. And it basically seeks to track the performance of the S&P 500 U.S. Dividend Growers Index, passively managed full replication approach, remains fully investing in large cap equity, emphasizing stocks with a record of growing their dividends year after year. So that's the key. And as we just looked at with their history, sometimes dividends don't always grow, obviously, at this rate. Like there's different stocks that have different growth rates of dividends. I just made a video comparing Coca-Cola and Realty Income and their dividend growth rates in one of my videos. And I think Coca-Cola won out in that case. And so with that in mind, like this ETF, roughly 100% dividend growth in the last 10 years, based upon the numbers they were paying back in 2014. You can see here about 40 cents a share. Now they're paying roughly 70 to 80, 90 cents per share. So they're definitely growing those dividends. They're focusing on companies that have a history of increasing those dividends. And of course, low expenses, which is typical with Vanguard, 0.06% expense ratio. If we look at right here, coming down to the actual portfolio, and then also the holdings themselves, you'll see we have Apple, Microsoft, JP Morgan, Broadcom, Procter & Gamble, MasterCard. A lot of these companies, and I think probably most of them actually are going to be what's called dividend aristocrat companies, meaning they've increased their dividends consistently for at least 20 years in a row. And so especially like Procter & Gamble, I know that one. I think Visa as well. So a lot of common names out there, a lot of large corporations that really, I mean, when you look at a company like any of these really on the list, these are high quality companies, large internationally based corporations that have a lot of cash flow, have a lot of earnings, and they're going to be able to pay out those earnings to shareholders. And the hope is that they'll be able to continue to grow those dividends over the long term. And thus what will happen is the dividends will go up over time. And roughly 100% dividend growth, I would say, over the last 10 years is not bad. That's why I like the Vanguard Dividend Appreciation ETF. Now, somebody who's interested in just focusing on the yield, something I advise against, would say, hey, it's only a 1.97% yield. What's the point? But just remember that dividend growth can add up over time, especially if you are reinvesting those dividends. With that being said, let's take a look at one more here for Vanguard. That one would be the Vanguard High Yield Dividend Index Fund. Over the last year, this one is up about 11%. So almost, I think, in line actually with the VIG ETF. We can compare those. I think they're pretty similar. But if we look at that here, the last year, which one is up more, kind of do a head-to-head comparison. That one's up 12.15%. Now this one is up 10.97%. And always remember, this does not include dividends or anything like that. This is just the share price since the beginning of the year, or over the last year, sorry. Year to date, this one is up 5.31%. So the Vanguard High Yield Dividend Yield Index Fund, this one, as the name implies, is going to focus on higher dividend yield companies, and it follows a passively managed full replication approach, provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields. So unlike the last ETF we talked about, we're not so much focused on the growth of the dividends over the long term, but we're focused on the actual dividend yield itself to offer a higher dividend yield. And in this case, we are getting a higher yield, not quite as high as V&Q, which was over 4%, but in this case, 3.45%. Now, if we look back at the last 10 years, let's see how the dividend growth is done. We can see that they were paying dividends of, let's say, 40 to 50 cents back in 2014, about 10 years ago. If we look now, going into 2024, they are in fact paying some higher dividends. But as you'll see, like in the first quarter, they only paid 65 cents. So even though the dividends are higher, they paid $1 here, $1 there, then they pay 87 cents. So the dividends are kind of all over the place. With that in mind, I mean, you do have some good dividend growth with this ETF. So I'm assuming there's maybe some overlap with this ETF and also VIG. We can look at the specific holdings to compare what they're investing in and exactly which companies. But as you'll see, like going back the last 10 years, they're paying definitely a lot lower in dividends. And you'll kind of see this gradual progression as we progress into 2017, 2018. 2020, and those dividends keep on going up. And now we're kind of approaching these types of dividends where we're getting anywhere from 80 cents, let's say 70 cents, a dollar per share, those types of things. And so what we have here are 3 solid ETFs that all pay dividends. Vanguard is one of my favorite companies just due to the fact that they have low fees. You'll see that this one also in the short term since November has gone from under $100 a share, now we're at $118 per share. And that's in line with the market going up as well. So overall, this bull market has been treating a lot of ETFs, a lot of stocks individually very well. You'll see the holdings breakdown here. This is finviz.com for this ETF. But with that being said, guys, thanks so much for watching. I hope you enjoyed this video on the 3 Vanguard Dividend ETFs. So these, one thing I forgot to cover with this ETF is actually the holdings themselves. I wanted to look at the holdings. So we have, some of the same companies like JP Morgan, I think, was on the other list, Johnson & Johnson, Procter & Gamble, a lot of those same types of companies that you're going to see in VIG, but in a different order, different percentage of the fund, right? So the top holding for this one is JP Morgan. I think Apple was actually number 1 in the other ETF. So you'll see a lot of the same large corporations, but sometimes there'll be different weightings depending on exactly how their dividend yield is, because this is more focused on the dividend yield itself versus the dividend growth. But nonetheless, I would say over the last 10 years, this ETF in particular has done a pretty good job, not only with share price growth. Look over the last 5 years, we have roughly a 33% gain. So not bad in terms of the dividend growth itself and also the share price growth. We have a consistent rate of return. But with that being said, guys, thanks so much for tuning in to this video. Hope you enjoyed it, and I will see you guys in the next one. God bless.